Where you should be putting your money. Our very own Scott Gam spoke with billionaire investor Ken Fisher of Fisher Investments. And Scott, I know you've talked to Ken Fisher for many years. What did you learn here about this latest interview?
Well, he's very much focused on global stocks. He likes Western Europe. He thinks sentiment is very low there. And, you know, as we like to say, you kind of buy when no one else wants to, right? You buy when there's blood on the streets. And Europe has been beaten down, at least from a market point of view, right? There's worries about their economy. Italy is technically in a recession. And he also had some very interesting comments on why the global market declined so much in December. And his reasoning is actually different than what many strategists had said at the time. So let's take a listen to what Ken Fisher told me.
December was largely caused, which still today people don't seem to understand, by the largest number of hedge funds closing without public announcement in the shortest period of time in history. That is, there's some 500 hedge funds we can see that decided to close toward the end of the year because they were too far behind their high water benchmarks, and they'd never get to the 20% carried interest. And therefore, it's more in their interest to close shop than it is to continue and start up in some new configuration. And so as that was going on, they didn't understand that the other ones were doing the same thing at the same time. And they didn't understand the market would decline as they had planned to do that. And you don't want to get to January 1st and have to do another year of accounting and regulatory and. So they get to December 3rd, and now they start just hitting each other. And as they're hitting each other, they're just knocking stocks down. It took us a little while in December to figure out that was what was going on. But the reality is once you get to that steepness, it's like a depressed spring. And when you get past the bottom of that, it springs back really fast.
Now that the market has recovered almost everything that it lost in the fourth quarter of 2018, how would you advise investors who maybe got caught up in the negativity and sold too soon?
So as I've said 2 weeks ago in my weekly USA Today column, there's just a simple rule, which is that third years of president's terms are positive. If you go back to the beginning of the S&P 500, the consistency of that is just stunning. It's the highest average annual. We haven't had a negative third year of a president's term since 1939, and it was only down 0.9% as World War II was starting. And the reason that works is because political risk aversion falls as you get to increased gridlock, which happens in every midterm election. And it surprises people that suddenly legislation doesn't go through. And think of it like when legislation's going through, you've got an obstacle course with big, sharp moving obstacles, and you got to get through the obstacle course. But once you get to heavy gridlock, the obstacle course is one with stationary obstacles, and it's a lot easier to get through, and people feel more relieved at that. And that goes on early in the year. Normally, the normal progression of the year in a third year is for the increase in the market to slow down in the back half as increased apprehension starts about the presidential elections. And that apprehension continues into the early part of the election year, but then the primary season winnows down the alternatives and the uncertainty there too, and the market starts to price that in the back half. So my general view of what probably happens in the period ahead, not certainly, but probably, is that we see a period where the market continues with volatility to rise, but slowing now from where it's been in the back half of the year, and then keeps slow in the beginning of next year, but then re-accelerates in the back half of next year.
All right, so there you have it. Even with a 16% gain in the S&P 500 so far this year, billionaire investor Ken Fisher still thinks there's room to run in this stock market. And guys, we also talked about the IPO market, right? That's a hot topic. You have a lot of retail investors interested in the Lyfts of the world, the Ubers of the world. Now, Ken is a little bit cautious on IPOs. He thinks that they're not priced right out of the gate for everyday investors. They're more beneficial to the bankers and some of the, other parties that are involved on the ground level. Right. So he advises waiting for the dust to settle. And Ken has a very simplistic investing strategy. ETFs, index funds, played straight down the middle. Don't try to time the market. The advice that we hear from a lot of big money managers tends to center around simplicity.
Scott, I know you've talked to him for years. Before I let you go, what is the one biggest investing tip you've got from Ken Fisher?
Well, I think what I just said, which is that keeping your investment strategy simple.
Long-term.
Because if you try to time the market, you have to be right twice. The other thing is, Ken has been pretty well known during the December sell-off to be a little bit more optimistic. So don't get too caught up in the negativity. And you heard him in that clip that a lot of the negativity was surrounded by closing hedge funds. That's a one-off event, not necessarily a chronic problem with the market.
Yeah, all right, Ken Fisher.